Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Trump's tariffs, talks of recession, the market is back in the green, but we are not out of the woods. In today's episode, Schroders' Kellie Wood explains why 2025 might have some surprises in store yet. Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, we have a huge episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Today, we are speaking to Kellie Wood, the head of fixed income at Schroders here in Australia. And we're talking about what's going on in the macro environment. It feels like that's all that everyone is talking about at the moment. Trump dominates our minds and dominates the markets, but for good reason, because where the US goes, the rest of the world will follow. And the US has been going here, there, and everywhere this year. Will they? Won't they? Tariffs on the world, tariffs just on China, pausing tariffs on China, well, reducing them at least for 90 days. There's so much happening. And through it all, Kellie thinks that 2025 might be the year where fixed income becomes a bit of a shining asset. So that'll be one to watch.
Absolutely. Now, this episode was recorded on the 29th of April, and of course, so much has happened between now and then.
Yeah, and we want to just clarify because Schroders' views move with the market as the markets change, people's opinions do as well. In the chat, Kellie mentioned that their models had a US recession at a 65% probability. With the recent trade talks, with the 90-day pause from the US and China. Well, sorry, I keep saying pause, but the 90-day reduction between the US and China. We reached out to Schroders to ask, had their models changed? And they said they're now putting the probability of a US recession at 30% rather than 65%. So as you said in the introduction, we're not out of the woods yet, but the probability is certainly less than it was when we recorded this just a few weeks ago.
That's it. Front page news.
What's front page news?
Chances of a recession are reducing. Markets are back in green.
Oh, right, okay. Now, this episode has been sponsored by Schroders, so we want to say a massive thank you to them for helping us keep all of the content we make here at Equity Mates free and available for all. So, Bryce, with that said, let's get to our conversation with Kellie Wood, head of fixed income at Schroders in Australia.
Well, Kellie, welcome to Equity Mates.
Thanks, guys. I'm very excited.
Nice, so are we.
So are we.
Yeah.
So we want to start with unpacking the market as it is today. It's been anything but boring. If you had to describe the market in one word, what would it be and why?
Oh, I think it's deserving of more than one word. Insanity, chaos, carnage, uncertainty and volatility. Like as we sort of came into 2025, it was, the environment was looking pretty good. If you think about US growth rates was around 2.5%, we had inflation at 2.8%, we had the US tariff rate at 2.8%. So a pretty good combination. And the Fed was on the path of engineering the biggest soft landing we have seen. Fast forward to today, and this was always the biggest risk with the US economy was Trump coming into power. And we're now looking at an economy where tariffs have potentially moved from 2.8% to over 20%. It's a $960 billion tax hike on the US, which will cost the US potentially up to 3% of GDP growth. And if you think about where we were before, 2.5%, that's growth rates in the US close to zero. And inflation potentially 4-5%. So an increase in inflation of potentially 2 to 3%. So a very stagflationary environment. And, the market has sort of repriced that outlook. So it has been chaos. It has been carnage. And just the general uncertainty and volatility in markets, have people stepping away from US assets.
So there's a lot to worry about there. And as a portfolio manager, in some ways, you have to worry about it all. Of those things, what's front of mind for you? I guess, what's causing the most concern?
Well, coming into the start of this year, we're always of the view that the US would catch down to the rest of the world. UK, European growth rates, Australian growth rates around sort of 1%, where the US was tracking around sort of 3 to 4% growth rates. But now we're very concerned about US recession. Where at the start of the year, our US recessionary indicator was sitting at around a 35% chance of the US going into recession over the next 12 months. That's now moved up to around 65%. And our threshold for thinking about, the real possibility of the market pricing US recession is around 50% on that indicator. That's probably our biggest concern. And then if you think about where markets are priced, and what markets are priced for a recession, most markets are very complacent. And this is where the environment is very different to what was sort of playing out in 2023, 2024. Growth was holding up, inflation was moderating, the US Fed was easing policy. That was Goldilocks. It does not get better than that, and that's when we were heavily positioned for risk on, owning a lot of credit and government bonds, and most markets delivered some great returns. But now the cycle has turned, and this is where bonds are back.
Bonds are back.
Bonds are back. Bonds are back. And I think by the end of today's session, you guys are going to be increasing your defensive allocation.
Okay.
Really?
Yes, because I know you like shares and the cryptos and cash.
We're young. We got time on our side,
Yeah, but you got to preserve capital on the way.
Yeah,
Okay, well,
that.
we will get to that, and I'm looking forward to being convinced. But Kellie, in late 2024, you made the prediction of the mother of all financial crises, a US default triggering global chaos. Can you explain why you think we're on that path?
Well, that prediction last year at Livewire, I thought that was a cracking prediction back then. And it's an even better one this year. And that sort of goes back to my comments on the cycle, now shifting to an environment where growth is slowing. Because debt is sustainable if US growth rates stays above the rate of interest that is sort of paid on borrowing. So the US over the last few years has been running this high pressure economy. So you've got monetary policy and fiscal policy, driving higher growth rates to deliver this sort of high pressure economy, which is sort of like the ultimate. You can have a lot of debt if you're in that environment. But today, we're now moving into an environment where growth could be zero in the US. If you think back to that $960 billion tax hike, if tariffs settle, anything higher than 10%. So debt now becomes very unsustainable when you see growth rates fall below that rate of interest. And then if you think about the US Federal Reserve, and this is where Jay Powell is in a very tricky position because inflation is likely to reaccelerate here and growth is falling. So for Powell to be cutting, we need to see a weakening in labour markets. And we may not see that. And inflation may continue to remain sticky, which has been sort of our view over the last few years, is just this higher for longer environment where the Fed put is no longer there. And you've got debt levels. Like the Congressional Budget Office just released their financial year 25 data at the end of March. And it's been a bit of a sideshow because you've got all this volatility around tariffs and the US economy. But over here, these guys have just said that by 2054, US debt levels will be at 214%. That is 47% larger than last year's baseline forecast.
Wow.
If the 2017 tax cuts, are made permanent, which is sort of Trump's main agenda now because the US is collapsing, and if interest rates go up by 1%, we're looking at some crazy numbers where interest expense is growing at a faster rate than Medicare, defence spending, interest expense has now overtaken those two components, Medicare and defence, in the budget.
Yeah, it's like the fourth largest line item in the US government budget. Yeah.
That's insane.
Yeah.
And, the scariest thing, which is sort of what I mentioned last year, was by 2034, like federal trusts on social security will be completely exhausted. Mm-hmm. Like, this is insanity.
Yeah.
And, this was always going to be the risk on the US economy, is that Trump would focus on trade, tariffs, immigration, which is an environment where growth will slow and inflation will pick up, before tax cuts and deregulation. So timing is everything.
Yeah. Wow. Well, I mean, more empires have fallen from debt crises than from, war. So
yeah.
The US, yeah. But I guess, like that, your prediction is so massive, a US default triggering a global crisis. You always hear that countries rarely have debt crises if they borrow in their own currency because they can print their way out of it. But yeah, like some of the numbers for the US are pretty scary. Debt to GDP is already, around 100%, let alone where it's going. But they also have to refinance, $3 to $4 trillion worth of their debt this year.
Yeah.
And, China's been the main buyer of treasuries. They're dumping treasuries. Like,
yes.
When you made that prediction, did you think about timing? Like, I'm surely you didn't think 2025 this happens.
Yeah. I'm pulling forward this prediction.
You are?
Like I'm getting on sports bet. Like it's like and you think about the environment we're in today, like global trade war, which like this morning I saw Paul Krugman say on his Substock that this is like COVID 2.0 but without a vaccine. And if you go back to that global trade shock, the vulnerabilities in the system, the US bond market being the backbone of the global economy, and if that starts to falter, then it's game over. And the biggest form of retaliation, back to sort of tariffs and sort of the game plan here, is retaliation from these countries, whether it be Canada, Europe or Japan. These countries own $8.5 trillion of US treasuries. That is the biggest form of retaliation, the dumping of US bonds.
So, I mean, the question has to be asked. Like, you said you're going to convince us to own bonds, but like...
Wait, I'm building the story. Okay, not US bonds. Back end US bonds. This is a very challenging environment for the US. And even this morning, looking at, I think it was Deutsche Bank put out an article this morning on the top 400 ETFs and the capital flows, around those assets over the last month. And there's been a huge capital outflow in terms of US denominated ETFs. You've now got this sort of end of US exceptionalism. You've got sort of capital flight out of the US. You've got a central bank that may not be able to save the US economy if growth slows because inflation is moving higher, and you have a debt problem. And if investors are sort of stepping back saying, well, I don't want to be lending money to the US government for 30 years if I don't think I'm going to get my money back. That means that investors need higher compensation, for investing in bonds, especially long-end bonds. So we still believe that back-end US-denominated bonds are vulnerable to sort of repricing. Even if the combination of growth and inflation still gets you to sort of nominal growth rates of 5, there's that real pressure of investors wanting higher term premia to be lending the US government money.
So I think that naturally leads to a question around positioning because I guess the beauty of the bond market at a time like this is its complexity. Like your positioning choices are so vast. Like the duration, the credit quality, the issuer, the liquidity of the asset. Like there's so many choices that you can make depending on how you want to position your portfolio. It sounds like there you don't want to own long-dated US government bonds.
Yep.
But aside from that, how are you thinking about positioning? And I guess how has that changed over the past couple of months?
Yeah, well, it's certainly been an exciting time, and for us as active managers, this is what we live for, because if you think of that environment, sort of post GFC, we had very low volatility. Growth and inflation was, very low. The opportunities within asset classes was, there just wasn't enough of them for active managers to actually outperform. Where now it's the ultimate. Like, this is what we live for. Like, the volatility and the opportunity in this new regime where we have so much dispersion in terms of where each country is in terms of its stage of the cycle, the volatility with Trump 2.0, and just the dispersion we're seeing in asset class returns, not just within fixed income like cash, government bonds, credit, high quality, low quality, but even across equity markets, whether you're investing in US or Europe or EM, like it's not about the beta anymore. It's about, themes. It's about sectors. It's about countries, which is a very different investing environment to that post GFC decade. Everything went up and everything went down. So in terms of positioning, like, we really have started to reshape our portfolios. So 23, 24, we're heavily invested in that soft landing view. And that's where we had a lot of credit risk within our portfolios, because in that sort of higher for longer, you want income, you had central banks cutting interest rates, inflation was moderating and growth was holding up. It just doesn't get better than that. So the last few years have been awesome for returns, especially for us as active managers. We've able to deliver close to 200 basis points over our benchmark from active rotation, being in the right assets at the right time. But coming into this year, with the, back to our recessionary indicators now sort of sitting around 65%, we've started to reshape. So we've increased cash across all our multi-asset and fixed income portfolios to around, on average, about 30%. Wow. We've started to increase our interest rate risk in our portfolios. And this is in countries where we believe, countries like Australia and in Europe, where if you think about the US, it's very stagflationary what Trump is delivering. But if you think about countries like Australia and Europe, or the rest of the world, it's very deflationary. So growth is likely to weaken, inflation is also likely to weaken. And that's where those central banks can come in and actually save those economies, because you've got growth and inflation down. So it's those economies, not the US, the rest of the world, that will actually do better. So adding interest rate risk in those countries where central banks can ease policy. The Fed may not be able to ease policy this year. If inflation is tracking 4-5% over the next few months and growth isn't weak enough, labour markets, are not weakening in the US, Fed's on hold. Equity markets, are you starting to see where I'm going with this?
What I'm hearing is like a sliver of good news for Australians, that you think that the central banks will cut rates here in Australia, the Reserve Bank will cut rates. So I'm just hearing Australian property.
Yeah. Look, I am so highly leveraged to Australian property. Like, I am married to a builder that buys any piece of land that's flat that's got a property on that can be detonated and, rebuilt. So... But yeah, look, back to the RBA, they need to be cutting here. Like, all the leading indicators of inflation are weakening, and the RBA really need to get on with it. And, if you think about this cycle, the Australian economy, or the RBA, sort of lagged, the easing cycle we have seen globally. And, you think about growth rates here in Australia around sort of 1%. And inflation getting back down within the target band of 2 to 3% over the next few months. And this is where, you want to be owning your interest rate risk in those markets where central banks can ease. We've seen it in Europe. RBA is certainly, one of those central banks that can take cash rates back down to neutral in this environment where growth is slowing and inflation is moderating. So, We're still quite cautious on US interest rate risk. Again, this end of US exceptionalism, back-end treasury yields being still under pressure, people sort of stepping back from lending the US government money. And, in terms of our other portfolio positions, so we've raised cash, we've got more defensive, we've been moving up in quality. So late last year, if you look at US equities, US credit, US bonds, very expensive valuations across all those markets. And the cycle had started to already turn. So the fact that valuations were expensive, the cycle was moderating, growth weaker, inflation potentially higher, sticky inflation, very bad environment for US assets. So we'd already started reducing assets like US equities, US high yield, moving up in quality. So moving shorter duration, moving a lot of our risk down the front of the curve and going higher in quality. You don't want to be in assets, that are vulnerable to this, US recession being priced.
I think the title of this episode might just be "Get Out of the US." But I think it is worth just reflecting on what you said there, which was like some of those indicators were that the cycle was turning pre-Trump's announcement, his Liberation Day tariffs and all that turmoil. Like, this isn't just like an event-driven situation where someone's put their finger on the scale and moved things. There was indicators beforehand as well.
Yeah, and Trump's election has really just supercharged that view we had. So coming into this year, we weren't positioning for recession. We were positioned for the US to slow, the Fed to continue to sort of ease policy as growth sort of moved lower, down back towards trend, 1.5 type numbers, and this soft landing view to continue to be priced, so that meant, credit still did well, government bonds did well, you may not be getting sort of the double-digit returns you've got from global equities over the last few years, but, it wasn't a collapse in the global economy. But now the cycle is looking more stagflationary with the Fed put no longer there and the potential for the US not to deliver fiscal policy when the economy is slowing because of debt levels already. It's an environment that's very bad for risk. And back to the earlier comments on, what markets are priced for recession, I think markets are so complacent. Like all markets, if you think about, US equities or just international equities in general, they're priced for around about a 10% chance of US recession.
Do you think that's because Trump is so flip-floppy? Like, what do you think are the reasons for that?
Yeah, and this is back to my earlier comment on, the backbone of the US economy is the US Treasury market. And when US Treasury yields, back at the start of April, like at Liberation Day, where we saw sort of the reciprocal tariffs, treasuries went from 4.5 to 4, back to 4.5, now sort of 4.6. So the risk of a sell-off in the US bond market, has got Trump sort of stepping back because that is the biggest risk here, that if you see interest rates go up, you'll see mortgages in the US go up, corporates, higher borrowing costs, you'll see the government having to slash spending. Businesses will not be able to expand. They won't be able to hire. You've got inflation accelerating. Like, mate, this is bad. That's one of the reasons why we've seen Trump pull back, because US Treasury yields were moving higher. There's a limit as to how far he can go, and I think there's that belief that there'll be a huge, backtrack on tariffs, and we'll all go on our merry way again. But you think about some of the data that's coming out now, like soy sauce in America is flying off the shelf.
No way.
Yes.
What, because they think that they won't be able to get it in...
Yes.
Yeah, right.
Yeah. And containers.
Americans should probably realise how much is made in China. It's not just soy sauce.
I love that. I just had to say that. But shipping containers from China to the US over the last 2 weeks down 30%. And what we're not thinking about with all these tariffs, that are now sitting about 20%, is supply chains.
Yeah.
And, and this sort of goes back to that COVID environment, that in a few weeks' time, there will not be too much on US shelves. Back to sort of the supply chains, like if that really starts to freeze up, and this is sort of back to sort of the recession sort of case, is that if these tariffs between the US and China stay on for even a month, then our probability of recession probably goes to 90%.
Yeah.
Because trade freezes between China and the US, the two largest economies.
Yeah. Axios had a story that the CEOs of Home Depot, Walmart and Target have all privately told Trump that they're going to have empty shelves sooner rather than later. So yeah, it's pretty scary. I think you may not have convinced us to up our weighting to bonds yet. You've certainly convinced us that this is a pretty scary moment to be, I guess, investing, or I guess a consumer generally. Is there any good news on your dashboard as you look out over the world? Maybe like here in Australia, is there... I assume that it doesn't look as dire here. Potentially there's opportunities in Australia. Our debt's not as bad. We're not as closely entwined in the trade war, although it is our closest ally and our biggest trading partner. But give us something positive to hang on to.
Well, I'm a bond investor. Even it's pretty hard to get positive. But there is some good news stories, and this goes back to my comments on the way in which investors need to be thinking about portfolio positioning today is diversification outside of the US. At the moment, the slowdown will originate from the globe, and this is China and the US, and potentially we're looking at a global trade shock that brings down the global economy. But there's countries, back to those central banks that have the room to ease policy. That is where you want to be investing. You want to be investing where cash rates are still quite elevated. If you think about where we've been over the last few years, central banks still have quite tight policy. If you think about the US at 4.5%, the RBA at 4.1%. So you want to be investing in those asset classes where the central banks can actually support growth. Like in the US, I would not be buying US equities until you saw the Fed easing policy. And that's where equity markets like Australia and in Europe, even emerging markets, I think emerging markets could be the real surprise here, that if we don't see recession, emerging markets should do pretty well in this environment. If we see this further weakness of the US dollar, that will allow emerging markets, central banks to ease policy. And we're starting with pretty high yields in those markets. So there's definitely pockets of value in economies where the cycle is more positive, where central banks can support growth. That's where you want to be investing. You don't want to be investing in, lower quality credit has expensive valuations and the cycle is very negative, because you're likely to lose money.
So there's a lot of, so the Equity Mates community is obviously made up a lot of retail investors, and obviously we all sort of have exposure through a number of ETFs and stocks to the US and a lot of the markets that you spoke about. We don't often get the exposure to, a lot of the products or bonds that you get to invest in. How should we be thinking about the defensive allocation? Do you have like a target percentage that we should be thinking about, and sort of what are some of the best ways that we can protect our portfolios?
Yes, I feel like you're coming around to the increasing the defensive portion of your portfolio.
At the moment, zero. So,
but you guys have cash, right? Have you
like an emergency fund? No.
In the asset allocation?
No. Or
we've got cash in our
tactically
brokerage account,
sometimes.
Yeah, technically.
Oh, gosh, okay.
we're risk on.
Risk on.
Aussie property and stocks.
Yes. Okay. So let's talk about how to preserve capital in this environment, because back to sort of the valuation argument, let's just say in general equities are overvalued here. and the cycle is turning more negative. So this is an environment where cash and bonds are likely to outperform equities. So you want to be increasing your defensive portion of your portfolio. So if you think of a traditional balanced portfolio, 60% equities, sort of 40% defensive or fixed income allocations. And when you want that fixed income allocation is when we're moving into a recessionary type of environment. This is where fixed income or duration-based fixed income or diversified fixed income that has a lot of interest rate exposure will actually protect performance. So when equities are down 50, 60%, your fixed income or defensive portion of your portfolio, if it has a lot of interest rate risk, should be delivering you double-digit returns because you receive the income. So at the moment, fixed income yields are around sort of 5.5% on sort of high quality investment grade credit. And then you look at sort of CBA dividend yield, 4%. I would much rather be buying 5.5% in terms of high quality income. And in that risk that we see recession priced into markets, this is where you not just get that income of 5%, you receive the capital appreciation as yields fall. So if, say, central banks have to come in and save the global economy, yields will fall by 200-300 basis points, back to more neutral levels. And having that much interest rate risk in your portfolio will deliver double-digit returns. So like a 5-year duration, we see a 200 basis point fall in interest rates. That will deliver you a 10% return plus the 5% income. Interested now?
Now
Not
you're
bad.
starting to.
Okay.
Now you're starting to talk
Okay.
out
I only start
language.
listening at 15% plus.
Okay, 50.
Now, if you
And
can
that's
convince Bryce a way to leverage that.
Yeah, true. Yeah.
leveraged fixed income.
Yeah. Now we're talking.
So when you think about the defensive bucket, it's cash, it's diversified fixed income, which is what I just spoke about, the income plus the capital preservation and the strong returns in terms of diversification versus equities in that bucket. And then we have sort of enhanced yield or sort of like your credit strategies, that are looking to deliver sort of cash plus 3%. So they're the three buckets investors should be thinking about in that sort of traditional 60-40 allocation, where that defensive bucket, you've got liquid cash, you've got diversified fixed income that will protect you for downside, produce a double-digit returns in recession, and your enhancing strategy, which is predominantly credit. So if you think about the last few years, it's been all about having a lot of money in that enhanced yield strategy in credit. Because we've been in that higher for longer environment and Goldilocks. Growth has been holding up, inflation's been moderating, central banks are cutting interest rates. So good. And these funds, these credit enhancing funds have delivered between something like 10 and 12% over the last year. They've smashed it. It's been less about diversified fixed income because we haven't actually been in an environment where the cycle is falling or growth is collapsing, but we now are. So you want to be thinking about, always having the cash buffer, but striking the right balance between protection in that diversified fixed income strategy and enhanced credit. I don't like to put sort of weights on each bucket, but like if you think about cash rates, term deposits over the last few years have been on average sort of 4.5%. Pretty good. We're now moving into an environment where central banks will have to come in to support growth rates. So that term deposit is going to be rolling from 4.5 down to sort of 2.5, 3%. So cash is good now, as to preserve capital, but we want to be owning more diversified fixed income type assets to preserve capital, as well as keeping your defensive portion of your portfolio earning high levels of income.
Okay.
And I think...
Okay. Are you warming up? I don't feel like I've convinced you yet,
Yeah,
guys.
no. I think you're getting there.
I think you're... Yeah.
I mean, to be fair, I have fixed income in my super fund, and I actually had a look the other day at how it was performing versus some of the equity component, and it's doing exactly what it's supposed to be doing. So
Yes.
I'm certainly convinced.
I think the good thing is the way that Bryce framed the question before was like there's a lot of products that retail investors like us haven't had access to. You know, like we can't go and buy bonds, you know, because like straight up because they're like $50,000 minimums or the like. And, you know, even a lot of funds traditionally, you know, the minimum investments were quite high, and, you know, we're not lucky enough to be on some of the platforms that can lower those minimums.
Yeah.
But I think the really good thing over the past, I don't know, call it 5-10 years, like in our investing lifetimes, is the accessibility has just got so much better. And,
Yes.
you know, Schroders has been a part of that. You've got High, which is listed on the ASX. You've also got Grow, which is multi-asset, but includes some of these assets and some of these strategies that we're talking about. So it's just made the whole world more accessible. So as you continue your pitch to convince Bryce and I to change our portfolio weightings, how should we be thinking about some of these like actively managed ETFs as part of a portfolio mix?
You know, the accessibility, you know, through to being able to move quickly into these investments, you know, it's sort of the click of the button, you know, through your app. And, you know, it's changed the dynamic, I think, especially for retail investors that couldn't invest in the bond market. You know, it was a very sort of institutional market, and the opening up of the ETF market is, you know, we're now looking at a huge avenue, you know, for us as fund managers to really penetrate, because retail investors, you know, in terms of their defensive allocations it was cash. You know, it was either cash or equities, sort of back to your comment, Bryce, that's, you know, we own a lot of ETS and shares. So, you know, it's a huge market, and I think this is where, you know, fund managers like us, this is what dreams are made of, because this is our time. And I think to be an active manager in this new regime and to have, you know, a new channel for distribution, you know, through to the retail guys that are predominantly just invested in cash in their defensive portion, you know, there's a huge level of education that, you know, us as fund managers can help, you know, you guys, in terms of your end consumer, get more aware of what's out there and how you can preserve capital in these periods of uncertainty and volatility. And these environments, and it's not going away. Like, it's a whole new regime out there where we have more volatility in terms of growth, inflation, the policy mix is changing. You know, it's fiscal and trade that's driving markets. It's a pretty exciting time. And, you know, we recently launched our Schroder high yielding credit ETF. High, I love that, which is the Schroder High Yielding Credit Fund. And this is the fund or the ETF that sits in that third defensive bucket, which is the strategy that will enhance your defensive allocation. So delivering returns of cash plus 3%. And here we're focused on buying Australian corporate bonds. So if you think about different corporate issuers, you know, they can either raise capital in the equity market or the corporate bond market. This fund invests directly in those issuers, Australian and global issuers that are issuing into the Australian market, so corporate and financial, both senior and subordinated debt. So this is a strategy that really aims to deliver cash plus 3% and looks to enhance that defensive allocation, you know, if we're thinking about yield. In terms of the investor that will be looking at this type of product, you know, we're looking at investors that, you know, enhancing yield, but also diversification away from equities. If you think about equity income. So the CBA dividend yield, 4%. We can deliver 5.5% in this strategy through a CBA corporate bond. So this is back to that sort of theme of fixed income valuations have been restored. We're now seeing better value in fixed income than equity markets and even cash markets, where we think fixed income can really be the year, you know, 2025 is the year that fixed income actually outperforms, you know, and it's this asset class in terms of yield above cash that can diversify away equity but also those direct hybrid securities. And I know a lot of retail investors, in terms of their defensive allocation, it's cash and direct hybrids. This is where something like the ETF like HIGH can diversify that away in terms of the number of different issuers, corporates, financials, senior, subordinated, in an environment where we can deliver, above 2 to 3% in terms of cash rates.
So, Kelly, I'm noticing a trend with Schroders tickers because I'm having a look at some of your other ETFs that are available, and one is PAYS, P-A-Y-S. You also got GROW, but PAYS is the Schroders Absolute Return Income Active ETF. How is that different to HIGH, and I guess how should we be thinking about that one?
PAYS is our sort of cornerstone defensive offering. If you think about those three buckets I spoke about, this is a top-down asset allocation fund that does deliver cash plus 3 to 3.5%, so a bit more sort of punchy. It's a top-down asset allocation fund that can be looking at moving between asset classes, so cash, government bonds, and credit. So as a retail investor, if you don't want to be deciding within your defensive bucket how much cash, how much government, how much credit, this is the one-stop shop for your defensive offering, where if we think credit markets will underperform, in this sort of US recession, we'll be owning more cash and government bonds to preserve capital. If we think it's a risk-on environment, this fund will be owning more credit risk. So it's definitely an income-generating type product that enhances cash returns. So another product that sits in that defensive bucket in terms of enhancement of yield.
Nice.
Well, that seems like our defensive allocation
that's the one.
in full there, doesn't it? Yeah, there we go. That's the one. So, Kelly, you came in today with an audacious task to convince us to increase our defensive allocation, especially for Bryce, who's not only risk on, but he's leveraged ETFs on.
US.
So let's just give you the platform to make your final pitch to the voters. Why fixed income, and why now? Why is 2025 the year of fixed income?
Well, guys, I don't think I need to say anything, but fixed income is going to provide you with...
Yes. Oh, no, it's Jan.
There we go.
We're on. For those not watching on YouTube, Kelly has just pulled out a money gun, and we're now surrounded in $100 notes.
$100 notes. 100 US.
100 US.
Yeah.
Well,
I'm
Kelly,
convinced.
if that doesn't convince us,
That was good.
I don't know what will. Thank you for joining us today. And if people want to find out more, they can look at HIGH and PAYS and GROW and all the good stock tickers out there that Schroders seem to have got. So thank you for joining us today.
Thanks, guys. Pleasure.
Thanks, Kelly.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.